Okay, picture this, a financial market just humming with energy. We're talking breathtaking highs, absolutely devastating lows, a place of non-stop drama where fortunes are made and lost in the blink of an eye. You've got wild rumors and gut feelings driving billion-dollar decisions, and the line between being a genius and just being a gambler, it's razor thin. So, what am I describing?
I mean, just listen to how one of the first people to ever write about it described the scene. Look at those contradictions. It's noble, but it's infamous. It's fair, but it's deceitful. This wasn't just a place to do business, you know? It was this moral battleground, a high-stakes arena where you saw every extreme of human behavior on full display.
And the stakes? Oh, they could not have been higher. If you were sharp, if you were disciplined, it was a touchstone, a way to prove your intelligence and walk away rich. But for the reckless ones, the audacious, it was a tombstone, a place where your bold bets and your overconfidence could and would lead to total financial ruin.
I love this quote because it just so perfectly captures how unreal the money felt. Profits are the treasures of goblins. One minute, you're holding diamonds, and the next, they've just vanished into morning dew, then tears. It's such a powerful way to describe how quickly a fortune could just disappear.
So, all of this, the wild speculation, that emotional roller coaster, the get-rich-quick schemes, and the catastrophic losses, it probably sounds pretty familiar, doesn't it? I bet you're thinking of modern Wall Street, or the crypto craze, or maybe even the whole GameStop saga. But what if I told you this scene has nothing to do with the 21st century?
That's right. This isn't today. This is Amsterdam. Over 300 years ago. The year is 1688. Turns out the world's first modern stock market was every bit as wild, as complex, and as psychologically intense as anything we see today.
And we know all of this thanks to one incredible source, a book called Confusion de Confusiones, written by a merchant and writer named Joseph de la Vega. This thing was published way back in 1688, and it's the very first book ever to really break down the inner workings of a stock exchange. And what it reveals is a financial world that was, frankly, centuries ahead of its time.
So what was fueling all this passion? What was everybody trading? Well, believe it or not, this entire massive ecosystem was built around the shares of just one single company, the world-changing Dutch East India Company, or the VOC. And this market, it developed fast. I mean, really fast. The VOC gets founded in 1602. Just a few years later, the idea of a tradable share, an actie, is born. By 1611, they've already got a dedicated building for trading, the Amsterdam Beurs. So by the time de la Vega is writing his book in 1688, this market had been running at a fever pitch for decades.
And to give you a sense of the scale here, by 1688, a single share of the VOC was worth around 17,000 guilders. That is an astronomical amount of money. We're talking more than 50 times the annual salary of a skilled craftsman. So this wasn't some small-time betting. This was the movement of immense fortunes.
Okay, so how did they play the game? Well, this is where it gets truly fascinating. The traders back in 17th century Amsterdam had a whole playbook of speculative tools and strategies that are frankly shockingly modern.
For starters, they had opties, which were functionally identical to our modern-day options contracts. A trader could pay a little bit of money for the right, but not the obligation, to buy or sell shares at a future date for a set price. It was an incredibly sophisticated way to speculate on where prices were going while strictly limiting how much you could lose. They also practiced something they called wind handle, which literally translates to wind trade. This was the act of selling shares you didn't actually own with a promise to deliver them later. Why? Well, you're betting that the price would fall so you could buy them back cheaper and pocket the difference. It's exactly what we call short selling today. And just like today, it was super controversial. It was actually banned as early as 1610, but, everyone still did it.
And because this wind trade was technically illegal, traders found this really clever loophole. If a short bet went totally wrong and you were facing a huge loss, you could invoke the appeal to Frederick. Basically, this legal edict just voided the contract because, hey, you never legally owned the shares in the first place. It was a perfect get-out-of-jail-free card.
But De La Vega's book wasn't just a technical manual. No, it was a deep dive into the psychology of the market. He identified these timeless archetypes of investors, the very same ones we see today. They just had different names back then. He called the bulls liefhebberen, which means the lovers. They were the eternal optimists who loved the company and were always expecting prices to go up. The bears, on the other hand, were the contramine, the underminers.
These guys were ruled by fear, always expecting a crash. De la Vega wrote that for them, rabbits become elephants.
They even had their own slang. A fleeting opportunity for a quick profit was called a basheel, which is the Dutch word for butterfly. I mean, it perfectly captures that idea of a beautiful chance that you have to snatch up quickly before it just flutters away.
So ultimately, De La Vega's core message was that the market is a confusion of confusions. It's a dark, complex world driven less by logic and more by raw human emotion. He understood way back then that it was fundamentally irrational.
And his advice for how to navigate this confusion? It is just as relevant today as it was in 1688. I mean, look at these principles. Never give advice. Take your profits when you have them. Remember that those gains can vanish in an instant. And to win, you need two things: patience and money. I mean, this could have been written by Warren Buffett yesterday.
But maybe his most profound insight is this one. It's basically the 17th century version of buy the rumor, sell the news. De La Vega knew that the hype, the anticipation, the human psychology of it all has a far bigger impact on the price than the actual news when it finally drops.
And that really brings us to our final thought. De La Vega's world of bulls, bears, options, and short selling, it all feels incredibly familiar. Sure, the technology has changed, but that fundamental game of greed and fear, it seems absolutely timeless. So, if the game itself is over 3 centuries old, is it possible that the players, us, haven't really changed at all?